The economy is booming. The White House says so, the Federal Reserve Bank says so, even the economists on Wall Street say so. But there's a hidden risk here that no one's really talking about. Let me show you. On one hand, the Fed says the economy is strong, and then on the other hand, they're cutting interest rates. Normally, the Federal Reserve Bank cuts interest rates as a way to stimulate the economy. For example, between 2019 and 2020, the Federal Reserve Bank cut interest rates from around 2.5% all the way down to 0% to get the economy moving. Between 2007 and 2008, during the Great Financial Crisis, the Federal Reserve Bank cut interest rates from 5.25% all the way down to 0.25%. And then during the dot-com bubble bursting between 2000 and 2001, the Federal Reserve Bank cut interest rates from 6.5% down to 1%. Now, when you dig into the numbers, you'll start to identify a trend. Number one, the Federal Reserve Bank cuts interest rates to stimulate out of a recession. But the second part to this is that the margin that the Federal Reserve Bank has had to cut interest rates has been getting slimmer and slimmer and slimmer. And that means the Federal Reserve Bank has to get more creative to stimulate the economy. Let me show you. During the 2008 financial crisis, cutting interest rates was not enough to stimulate the economy, so the Federal Reserve Bank had to get creative, and for the first time, they launched what was known as QE, or quantitative easing. Quantitative easing is when the Federal Reserve Bank uses their money that they create to go out and buy some sort of asset, like treasuries, in order to stabilize and support our economy and keep our credit system working. In other words, it means the Fed is printing money to buy up assets to prevent the economy from entering freefall. Now, to demonstrate what I mean, let's take a look at the size of this quantitative easing. Back during this 2008 crisis, the quantitative easing was around $1.25 trillion, which was a very big deal because we had never seen a stimulus program like this before. And then came the 2020 pandemic, and of course, cutting interest rates from 2.5% to 0% wasn't enough between 2019 and 2020. And that was where we saw about a $5 trillion spending program by the Federal Reserve Bank in order to stimulate the economy. Now, of course, there's implications to this type of quantitative easing, which I'll get into in just a minute. But let me explain what's going on today. Today, the interest rate set by the Federal Reserve Bank is set at 4.75 to 5%. It's a range. That's where we are today. And the Federal Reserve Bank has said that they plan to bring this interest rate down by 2% over the next 18 or so months, even though we're in a strong economy and they don't predict any sort of economic pain. Now, this might sound like good news to you if you're thinking about financing a car, if you want to get a mortgage to buy a home because it makes your debt payments a little bit cheaper. But I want to focus on the macro economy and how this can impact what will happen the next time we see a recession, because we know that recessions happen. Recessions happen in the United States. We've seen a recession pretty much every decade for the last century. We saw a recession in 2020. We saw a recession in 2008. We saw a recession in 2000/2001. We saw a recession in 1990 since 1991. We saw a recession in 1981. You get the point. Recessions happen. We're going to see more recessions in the future. So the question is, if we're cutting interest rates now, when we're already in a strong economy, what's going to happen if we enter a weak economy? How will the Federal Reserve Bank stimulate then? Because we know that a recession is coming. Of course, nobody knows when. We don't know if it's going to happen next year or 10 years from now, but we know that a recession will happen. And if interest rates are already low entering the recession, then how will the Federal Reserve Bank stimulate when we're in that next recession? Now, before I answer that question, I want to remind you that if you're an investor and you want to stay up to date on what's happening in the financial markets, Market Briefs is a free newsletter that I created where every day my team is working to break down what's happening in things like the economy, the stock market, the housing market, the crypto market, the global economy, and our own economy into a fun, witty, and easy to read newsletter. We have over 250,000 investors reading Market Briefs every day, and it's completely free. So if you have not joined Market Briefs yet and you want to join, I got the link to how you can join for free down in the description below. So now if we go a little bit deeper down this hypothetical, the question is, if the Federal Reserve Bank cuts interest rates to a lower amount, and then we see a painful recession at some point in the future, who knows when? But let's say in the next decade, we see some sort of economic slowdown that now the Federal Reserve Bank wants to stimulate our way out of. What do we do if cutting interest rates isn't enough because we don't have enough margin in cutting interest rates? If we go down to zero interest rates, what will the Federal Reserve Bank do next? Will they do more quantitative easing? Or are they going to do negative interest rates, kind of like what we saw happen in Japan? Or will the Federal Reserve Bank do something creative? Now, when I say something creative, I mean something new that we have never seen before. For example, during the 2020 pandemic, the Fed did this. The Fed, for the first time in the history of time, started printing money to buy corporate bond funds. What that means is during the 2020 pandemic, the Federal Reserve Bank started creating money out of thin air to lend money to corporations by buying these funds of corporate bonds. A bond is a loan, a corporate bond is a loan issued by a company, and because corporations couldn't go out and raise any financing, the Federal Reserve Bank stepped in and lent money to these corporations indirectly by buying these corporate bond funds. Now, of course, there's consequences to this because there are some companies that won't be able to get that money, while other companies do. So how do you pick and choose? And then there are other hidden consequences, which I'll get into in just a minute. So now the question is, what does this mean for the long-term health of our economy and our currency? Because if the Federal Reserve Bank can't cut interest rates low enough from 3% down to 0%, if that's not enough to stimulate the economy in the future, that might mean that the Federal Reserve Bank has to print more money. Maybe at some point in the future, we could see negative interest rates like Japan, or maybe that means the Federal Reserve Bank has to get more creative with how they stimulate the economy, which ultimately would mean more stimulus in different ways. But there is a consequence to this, because if we look at this from a broad perspective, if the government wanted to spend money, the way that they do that is by going to Congress and saying, hey, we want to build a $1 trillion infrastructure package, and in order to finance this, we need to create this tax. We have to tax the rich people, we have to tax the poor people, we have to tax somebody to raise this money to build this infrastructure program. And when you do that, you know where the money is coming from. The problem is what we've been seeing happen is the government says we want to pass this $1 trillion infrastructure program. But we don't want to go through Congress because they're not going to accept it. So we're just going to spend the money anyways, even though we don't have the $1 trillion. So then who pays for it? Because if the government imposes a tax, a one-time tax on rich people to build this infrastructure program, we know where the money's coming from, because then you could just take a look at who's paying the taxes. But if that's not how it goes, then the government still spends the money, then where does that money come from? And this is what's known as the hidden tax, because a dollar still has to come from somewhere. And this is where the Federal Reserve Bank will then print that money, lend it to the United States government, and then they can still do the infrastructure program, but then somebody still has to pay the price. And the answer is, number one, everybody pays the price because it's a hidden tax. And what I mean by that is when you print money, when you create money, there's a cost to that, and that cost is inflation. And if you don't understand the cost of inflation, then you're probably the one that's paying the burden of inflation. And what I mean by that is inflation disproportionately hurts certain people more than others. Inflation hurts consumers. Everybody is a consumer. Rich people are consumers, middle class people are consumers, poor people are consumers. Everybody consumes because everybody has to eat, everybody needs a home, everybody has clothes. So everybody is a consumer. Inflation means you gotta pay more money to consume. So when you go buy your extra guac, you gotta pay more money for that guac. But inflation also disproportionately benefits certain people more than others, because inflation disproportionately benefits the investor. When inflation happens, you spend more money at a business. And that means more dollars are flowing to the owners of the business, which are the, of course, investors. So if you gotta spend more dollars at Chipotle to buy that extra guac, that means those dollars are ultimately floating up to the shareholders of Chipotle, the owners of Chipotle, the investors in Chipotle, who then are accumulating more of those dollars. So inflation hurts everybody, but then it ends up benefiting the investor. And this is where when you see this type of this money printing, that has a consequence. Now what I like to say is the most expensive kind of money is of course free money, because the person who pays the price is the person that doesn't understand it. And so the average person ends up getting hurt even more. That's the first cost, which is the hidden cost, the hidden tax, which is of course inflation. The second cost is then the government has to pay this money back plus interest, because the United States government has this national debt, and then every year the government has to make payments on this national debt, which is their interest payments, and the government has one source of income, which is tax dollars through taxpayers, which means more and more of our tax dollars have to be used then to pay back these debts plus interest. And we've also been seeing that our net interest expense here in the United States is not only the fastest growing expense, it is now the third largest expense, which means the United States government is spending more money on its interest payments than it is on its own military. So when we continue to have these sort of quantitative easing programs, these, number one, add to inflation, and then number two, they add to the national debt, which means the government then has to spend more tax dollars to pay back the debt, which means the government then needs more tax dollars, which could lead to higher taxes and slower economic growth. And that's why I want you to understand this, because normally we stimulate through lower interest rates when you have some sort of worries about an economic slowdown. But right now, the economists and the Federal Reserve Bank are saying there's no worries about an economic slowdown. The economy is booming, the job market is strong, inflation is fine. And if that's the case, then why do we keep cutting interest rates? And these are things I want you to just ponder on. But at the end of the day, we can't control what other people do. What you can control is what you do in your own house, which means you have to now make smart financial decisions. And that means, number one, be prepared. Get rid of your credit card debt, have cash to protect you against an emergency, and have cash to be able to capitalize on an investment. Number two, invest in your financial education. Learn how to read financial statements. Learn how to analyze an investment. Learn how to listen to an earnings call. And then number three, pay attention to the financial trends. Look at different industries, see where the money is moving. That way, when you see a good opportunity, you can come in and capitalize on the opportunity. And of course, we'll be keeping you updated on the market briefs. So if you have not joined yet, I got the link for you down in the description. We just entered the next phase of the global economy. The Federal Reserve Bank is now cutting interest rates. Canada is cutting interest rates. China is now cutting rates. And countries across Europe are also cutting interest rates. And we've also seen some countries now start to protect themselves against any sort of potential economic uncertainty by buying things like precious metals.